All right, why don't we get started? So, thank you very much for joining. This evening, we're going to talk about passive income and how to generate it and some different considerations that people should have. I think I have the chat enabled tonight, which is good news. So, I will send through right now. Oh, that switched the slides, did not send. There you go. So, I just sent in the chat, which hopefully everyone should see. First of all, my email address, so anyone can contact me with any questions, and then just some articles that I'll probably reference tonight for people that are interested. One other thing, I have gotten a couple requests for the recordings for the previous two webinars we did on Tuesday night, and we're working on them. We should have them hopefully by the end of this week. So sorry about that delay. And yeah, let's get into it. So the first thing to say is anything you hear tonight is general advice. I obviously don't know anything about you. I can't offer personal advice, but questions and participation is obviously great. I think that can allow me to tailor where we're going. So if you do have any questions, pop them in the chat or send them in the Q&A. And yeah, we'll get started. So yeah, passive income. So first of all, just a brief description for people to understand where we're coming from. So passive income is an income stream that it takes little effort to acquire, which probably lets you know why this is attractive to people. So obviously, this is in contrast to non-passive income, which would be something like a salary where you need to go out and work. And passive income can come from a lot of different places. So, of course, dividends can be paid by shares if they have the ability and the willingness to do that. And of course, any vehicles that hold shares, so a fund or an ETF, for example, you can get interest payments from bonds or cash or anything kind of in between, whether we're talking hybrids, term deposits, things like that, or of course, any of the investment vehicles that hold those securities. You can get rent from listed properties, so something that trades on the exchange, like a real estate investment trust, a REIT, or unlisted property, so funds that invest in unlisted property. I got a question about being on mute. Can people hear me? Hopefully I am not on mute. Maybe it's a setting on your computer. Okay, good. So people can hear me. So I would just check. Your computer, see if it is on mute. So you can obviously get rent from listed, unlisted, or fully owned real estate. So obviously, if you own property yourself and are collecting rent on that, you can earn passive income. And then, of course, there are certain business ventures that require little or no effort, where you can earn passive income as well. So tonight, we're primarily going to concentrate on shares, talk a little bit about fixed interest and cash, and obviously happy to answer any questions on that. And one of the reasons that says at the bottom of the screen why passive income is so attractive to people is, one, the idea that you can fully or partially replace your salary is obviously attractive if you want to try to retire early. The other thing that's really attractive about generating income from your portfolio or from other sources is that it can mitigate the risk that comes from the volatility of asset value. So really what I'm talking about there is that we all invest for unique reasons to ourselves, but a lot of it is just obviously deferred spending. So we are saving money now, we are investing, and we plan on spending that money in the future. So retirement's a perfect example. You contribute to super. At some point, you'll draw down that super. Now, traditionally, the way that we thought about drawing down investments or extracting cash that we can spend from investments is to sell those investments. And that does put you at the mercy, of course, of fluctuating asset values. So if we think about the share market goes up and down. If you are retired and you are trying to extract money from your portfolio to pay for your life, you're at a mercy of where those prices are when, in that case, you are forced to sell. so that you can pay for your day-to-day living expenses. One of the things that's very attractive about passive income, it just does mitigate that risk. And I'm not going to spend too much time on that tonight, but we're really talking about the risks that you face as a retiree, which is sequencing risk. So the sequence of returns that you don't want really negative returns early in retirement, because that is going to impact how long your portfolio lasts. And then longevity risk, the risk that we live a very long time. And of course, you need money to pay for that longer life. And so generating income from your portfolio can either partially or fully mitigate those risks that you face. So another reason that passive income is very attractive to people. All right, so let's get into a couple of the topics we're going to talk about tonight. So wanted to very briefly look at income from different sources and income from different investment sources. So of course, we're ignoring things like fully owned residential property. Really, this would apply from a share perspective to listed property or something you'd invest in, like a REIT. So we're going to look at shares, bonds, and cash. We're going to look at three different factors that we'll talk about a lot tonight, but are big impact or are big considerations for investors that are looking to generate passive income. So the first is the variability of income. And for a lot of people, that is a goal of the income streams that they're trying to generate, that we don't want them bouncing around if those income streams are paying for our life, because we'd like to have predictability into our budgets for the coming years and how much money we actually have. So if we look at shares, there's a couple different considerations, one good, one bad. Start with the bad. So the first thing is dividend income is not guaranteed. So we'll talk about this more a little bit later, but dividends, of course, there's a couple different factors. One, it is willingness of management to pay them. It is a choice, management of a company, and it's also the ability of a company to pay dividends. So obviously that is cash going out the door, which means the company needs cash coming in the door to pay them. And so you do go through situations where dividends can be cut or eliminated. So it is something to consider. Now, obviously this is a little bit of an outlier situation. We saw a lot of dividend cuts around COVID because of course the revenue and the income that companies were generated fell significantly as the economy shut down. So that is something to consider around dividend income in terms of variability from shares. But the other very, very positive thing about shares is that that dividend income can grow over time. And we'll talk about how that happens a little bit later. So you do have that worry that you need to guard against dividends getting cut or eliminated, but you have the potential for a lot of income growth. If we move over to bonds, it's a little bit of a different story. So interest income that comes from bonds can, of course, be cut or eliminated, but it is a contractual obligation, which means that in order for that to happen, the entity that's issuing that bond would have to default, basically say they can no longer pay, which generally, if we're thinking about a company doing that, if it's a corporate issued bond, means that they are going bankrupt if they're unable to meet those contractual obligations to pay their debtors or to pay their creditors. If we talk about a country can also technically default. It's a lot harder because countries, of course, are in control of printing more money. Not that that's a good thing for us, but a country can default as well. And we've seen defaults, and Argentina is what people always use as an example, but we've seen defaults historically particularly when countries are borrowing money or issuing bonds in foreign currency where they have no ability to print more money because they don't control that money supply. So that can happen, but remember, interest in general is guaranteed. So something to consider. The problem with interest is most of the time with fixed rate bonds, the interest over the lifetime of that bond is set. So you're not going to see growth. So for instance, a bond will be issued at 4%, a 10-year bond. You know what you're getting for 10 years. You are getting 4% in interest, and you're not going to see growth in that income stream. And of course, that can be a problem, particularly if there's inflation, because what is being paid out to you, of course, the purchasing power of those interest payments will go down as inflation goes up. The other thing that you face with bonds is what we call reinvestment risk. And basically what that means is that it's fine that you go out there and buy this 10-year bond. You know exactly what the interest payment is going to be over the lifetime of that bond, but you're really at the mercy of where interest rates are when that bond matures. And so when that bond matures, if interest rates have gone from 4% to 2%, all of a sudden you're getting less income because of that reinvestment risk. So that's what we consider when we're looking at bonds. Finally, if we move over to cash, we look at term deposits. Same thing. That interest is guaranteed. That interest is guaranteed for that term deposit, and obviously the cash that you put in there, depending upon how much you have, is guaranteed by deposit insurance and backed up by governments. But of course, you also have that reinvestment risk with shorter term, generally term deposits. So it's great. You have 4%, same example, that term deposit matures. The value that you're getting or the income that you're able to generate off that same money, of course, goes down over time. I did see something come through the chat. There are variable rate bonds, which is certainly true, Joseph. So variable rate bond, there'll be terms within there, which means that it's basically floating with interest rates. So what's normally looking at is something like LIBOR, which is an international interest rate that is published and fluctuates with interest rates, plus a percentage on top of that. So there are variable rate bonds. So that is true, and those interest payments will reset based on the level of interest rates and according to the terms of the bond. So they may reset after a set interval of time. So we'll get into it's not really a topic for today, but the second part of your comment, Joseph, I'll mention in a second. Taxes are obviously a consideration with any sort of income that you earn, because what's most important is, of course, what you get after tax. So there really is no difference at a surface level when we look at the taxes paid on shares, bonds, or cash. It depends where that investment is held. So you're paying your marginal tax rate. If it's held outside of super, you are paying 15% during the accumulation phase of super. Then when you move into pension phase, that tax could be 0%, or is likely 0% for you. So that is the same across the board. There are tax advantages to investing in shares. And I'm not going to spend a ton of time on franking credits tonight, but that advantage comes from franking credits. So what a franking credit is a credit that's issued to you, the holder of a share, if you're an Australian investing in Australian shares, a credit for the corporate tax that the company that you own shares in is paying. So of course, that's eliminating that double taxation of dividends. You are an owner of a company as a shareholder. Company you own is paying taxes. You're getting issued a credit for that tax. So there are a lot of tax advantages around investing in Australian shares if you are an Australian through those franking credits. So that's an important consideration. Franking credits, because I got this question last week and I get it all the time. If you hold an ETF or a fund, those franking credits will still be issued to you. So there's pass-through entities that pass through those franking credits. Finally, we need to look at total returns. And we're going to spend some time looking at income versus total returns, and the contribution that they make to total returns. So if we look at shares, dividends do play a significant role in terms of contributing to total return. So I put up some stats around Australia that if we go back 20-year period through November of 2022, which is the last data that I could find, 51% of total returns came from dividends. So that means that, yeah, over half of that total return that you always see actually comes from dividends, with the remainder coming from capital gains. So that's price appreciation that you have in those shares. So dividends are a very important contributor, and we'll talk about that a little bit later. Bonds, if you are in a fixed rate bond, if you get the bond at par, so when it's issued, you hold it to maturity, your entire return comes from the interest rate that you are paying. Now, bond prices do fluctuate, as Joseph had in his comments. So if you are trading those bonds, if you're buying or selling them during that period, you could get capital gains or capital losses off of that bond. But if you're buying an individual bond, you wait until maturity, that entire return that you're getting is represented by that interest rate. They'll give you back your principal at maturity, but that's your return. Same thing for cash. So all of your returns, the entirety of your returns is coming from that interest rate. One really important consideration, and if people have questions about this, I'd be happy to answer it, but people use the term dividend or interest often to apply to ETFs or funds that hold shares or bonds. Technically, what you are getting issued, if you're an ETF holder, for example, what you're getting issued is a distribution. It is not a dividend. So the distribution is made up of two different components. So it's made up of any dividends, let's say it's a share ETF, it's made up of any dividends that are paid by the companies that are held within that ETF. And it is also capital gains. So we talked about this a little bit last week in terms of looking at portfolio turnover in an ETF or fund. So just remember that some people can see more fluctuations in those distributions that come out. So if the ETF or fund is rebalancing and markets have done very, very well, then that's great. But if they're rebalancing and selling those appreciated shares, it's going to show up in that distribution. Markets then do really poorly and they're rebalancing, there may be no capital gains. So that distribution may vary, even if those dividends did not vary at all. So hopefully that was clear, but I'd be happy to answer questions on that if people have them. All right, so let's talk about a couple of considerations. And basically, I'm going to walk through a couple of these, and then we'll cover these in detail in some upcoming slides. But really, when we're talking about generating passive income out of our portfolio, there are a couple of things that many investors look for. So obviously, think about your own situation. Think about if these are things that are of interest to you, attributes that you're looking for. But many investors seek stability of income generated from the individual investments. And the reason that they do that, of course, is because if we're thinking of passive income as potentially a salary replacement mechanism, well, we like to understand and know how much we are making, just like I think all of us that are still working would like to know our salary so that we can, of course, plan and budget. So people find stability really, really important. And we're going to talk more about the sustainability of dividends, because as I said, dividends can, of course, be cut or eliminated. And so that sustainability is really important for a lot of investors. Also, growth is really important. People want to grow that passive income stream. So that's something that a lot of investors are looking for as well. And we have to remember, once again, we'll go into detail around this, but we have to remember that, of course, we have to remember where that dividend income comes from. Well, it comes from, of course, money the company makes. So if we want to find shares that grow their dividends over time, what we need are, of course, shares that grow their earnings, so grow their revenue and grow their earnings over time. So that's really, really important. And we'll spend some more time on that. Another thing that we're going to talk about is the trade-off between high current yields and future dividend growth. So when we say dividend yield, all we're doing is we're dividing the dividends that were paid over the last 12 months by the share price. And people use this as a proxy of what they can expect going into the future. Now, there are some pitfalls with that, which we'll talk about, but a lot of people think that becoming an income investor, and we're really going to hit this point a couple times, people think that becoming an income investor is very simply sitting there and saying, okay, well, I'll just look for the shares that have the highest dividend yield and I'll buy those. But remember, there are trade-offs between that, high dividend yields, potentially sustainability, which we'll talk about, and also growth over time. We'll talk about why. But just remember, if we're building a portfolio, that we want to include both. We want to include high current dividend yields that give us that current income that we want, but also we want growth involved as well, because of course we want that income stream to grow. Other thing that's really important is when we think about dividend growth in a share portfolio, there are three different ways that we can grow the income in our portfolio. One is, of course, dividend growth. So as I said, the company can raise dividends going forward. That's one component. Another component, how we can grow that income if we are not spending it right away, is through dividend reinvestment. So dividend reinvestment simply refers to the fact that a company pays you a dividend and you can reinvest that. Now, there are, of course, dividend reinvestment offerings that a lot of brokers have that will automatically reinvest that dividend. So basically, instead of $100, you get $100 worth of shares. That, of course, grows your income because you have $100 more of shares. So you have more shares, you get more income in the future. But dividend reinvestment can also apply to just the fact that you might collect dividends in cash in your portfolio and reinvest them in something else. It can be a completely different company, ETF, whatever. So it doesn't necessarily have to be in the same, but just that act of compounding your income growth by reinvesting the income you have. If you are still in that accumulation phase, you're not spending those dividends. And then finally, the last one is, of course, increased savings. So if we're saving more money, we're buying more shares, that will also grow that overall income stream. So we'll spend a couple more minutes on that in a second. So I'll just pause. There are two questions. Okay, so the anonymous identity says, where do you buy bonds with variable rates? This is only when the issues first come up through the big banks or RBA. Some bonds have variable rates. A good example that a lot of individual investors do gravitate towards are hybrids. So a hybrid is well, it's exactly what it sounds like. It's a hybrid. It's got some qualities of fixed interest. It's got some qualities of equities, but those are normally variable rate. So really what you're looking for there is just the terms of that bond. So anyone can issue a variable rate bond. It's just really about going out there and finding those bonds. Are there things like voting or rights issues to buy shares pass through ETFs? So generally, the voting that goes on, so proxy voting that goes on. So proxy voting is shareholders voting on certain resolutions. So a resolution could be something around executive pay. A resolution could be if a bid comes in to acquire a company, shareholders have to approve that. Those are generally voted, or they're not generally, they are voted by the company that issues that ETF. Some companies will make their own decisions on how to vote. Some companies outsource those voting decisions to a third party. It's supposed to be neutral and makes a decision on each of those shareholder resolutions. But no, you do not get to vote as an ETF holder. So that will sit with the issuer of the ETF. So a Vanguard, a BlackRock, State Street, companies like that. Good question. What are the tax implications of dividend reinvestment? That's a really good question. So there's a couple. So the first tax implication is that you still need to pay taxes on that income. So if a company pays you, same example, $100 in dividends, you have that automatically reinvested. You buy $100 worth of shares, you still owe tax on that $100. So just because you've reinvested it doesn't mean you get to ignore the tax. It also will make things a little more complicated from a capital gains perspective. Basically, that will be a new lot of shares. Those shares will be purchased at the existing price when that dividend is paid. And so, yeah, it makes it a little more complicated when you're selling because your cost basis on each one of those dividend reinvestments that you receive will be different than the original shares you bought. So that's a good question, Steve. All right, so let's keep moving through here. All right, one of the things I hear a lot when I talk about income investing is this notion that people think there are trade-offs between investing for income and growing your portfolio. So basically generating those capital gains in your portfolio. And I think it's really this notion around income investing that, oh, it's for people in retirement. Like, why would I'm not saying I'm young, but why would someone who is young be interested in income investing? They're actually interested in growth. And I think this is a huge mistake and misnomer around income investing. And really, there are studies, and one that I mentioned and link in one of those articles I put into the chat at the beginning, the Why I'm an Income Investor article, is this study that came out by Hartford Funds and Ned Davis Research. So Hartford Funds is a U.S. Managed fund issuer, or mutual funds as they're known in the U.S. And what they did is they looked at the S&P 500, so the 500 largest shares in the U.S., and they went back and they looked at returns between dividend payers and non-dividend payers. And you can see the time period is a long time period, so 1973 through 2022, so 50-year period. And they looked at the returns you're getting from those two cohorts. So what I'll do is I'll talk about each one of these, but really we can start at this bottom: dividend non-payers, and then dividend payers, this second line. So what you can see is the returns from dividend payers are actually higher than the returns from non-dividend payers. So making a decision on a share based on whether it pays a dividend or not, what this is telling us is that is not going to have any impact whatsoever on the capital gains that you generate. In fact, the only impact it would have is you're more likely to get higher ones if historic returns repeat into the future. So that's one implication. And another implication that we're going to spend some time talking about is the different categories that they've broken this up in, and really those shares that you want to invest in. So I will spend some time on this later. I have the same chart on a different page as well that we'll spend some time on those different categories. But another thing that's really important to note is that in investing, there's supposed to be a trade-off between risk, and the way that we measure risk with investing is volatility, how much prices bounce around, and returns. So the more risk you take on, so the more volatile an asset, the higher returns we're supposed to get over the long term. And that's supposed to be our reward. That yes, our portfolio may bounce around a lot, it may drop a lot at a certain point, but over the long term, we'll be rewarded with higher returns. And that relationship doesn't actually hold true. If we look at this research on 500 largest companies in the US, you're actually getting lower risk from investing in dividend-paying shares than non-dividend paying shares. And there's two risk measures on here. I'll spend a second on each one of these. We're not going to delve into risk too much, or at least the technicalities of these measures. Beta is one way we measure risk. So beta refers to, it's comparing an index, basically a group of companies, with the individual holdings in that company. So the index, in this case, the S&P 500, the beta would be 1. So that's our baseline. And then a beta that is less than 1 is companies that would move, share prices that would move, change value and price, less than the overall index. Over 1 is more than the overall index. So that is volatility both on the upside and the downside. So you'd expect if the market moves 10% and the beta was 0.8, then you would expect that share to go up 8%. Market falls 10%, you'd expect it to go down. So betas less than 1 indicate lower volatility. So you can see right here with the dividend payers, the beta is 0.94 compared to non-payers where it's much higher than the overall index. The other measure that is often used to measure volatility is called standard deviation. So very quickly, what that measures is the dispersion of returns compared to the average, right? So if the average return over a time period is 10%, the higher the standard deviation is, the more it will bounce around that average return. Very high standard deviation, it could return 20% one year, 0% the next year. So standard deviation lower, without going into the details, lower is less volatile. So you can see once again that dividend paying shares have a lower standard deviation than non-dividend paying shares. So really the point of this is you are not actually giving up returns from a historical standpoint. And this is not a choice. And a choice that somebody needs to make. Is my portfolio going to grow, or am I going to generate income? So just a really important consideration. Let's talk about picking shares with the highest yield. So a dividend is, as it says on the top, a capital allocation decision by management. We got to think about a business. We got to put our business hats on. And a company, hopefully, generates cash flow. So they've got cash coming in the door after they pay for the cost to create their goods and services. So they create goods and services, they have overhead costs, they sell those goods and services, and the difference is cash flow. We can call it earnings, we can call it cash flow. There are some technical differences, but anyway, money coming in the door. Now the company with these profits, with this cash flow, can make a lot of different decisions about what to do with it. And these are called capital allocation decisions. And they're very important because if management of a company makes really poor decisions with their money, well, that's not great for us as shareholders. So some of their choices are they can, of course, pay you dividends. That's what we're talking about today. The other thing they can do is they can buy back shares. So reduce the number of shares that are outstanding, which increases the profit that's allocated to the existing smaller shareholder base. They can repay debt. They have debt, they can go out and repay that. They can fund growth initiatives. So growth initiative could be launching a new product, so investing in the research and development to create that new product. It could be spending more money on marketing. It could be hiring a new team to go out and try to sell a product. It can be building a new factory if it's an industrial company. All sorts of things they can invest in growth initiatives. If you're Qantas, you can go buy a new plane and set up a new route and hope that you make more money off of that. So that's another option. They can also go out and acquire other companies. So that's an option that companies can have. So the problem that we can run into is that if too much is paid out in dividends, then there isn't enough left over to pay for some of these growth initiatives, to grow those earnings over time, which will grow those dividends over time. So we just need to think about those trade-offs that occur. Now, I think personally that, there's probably, and I wrote about it in one of those articles that I included in the chat, I think that there's too much of a worry that a company paying a dividend is not going to be able to fund growth. There are, of course, other ways to do it. But we do have to think about those trade-offs and be wary of companies that just chasing that highest yield. We'll talk about a dividend trap in a second, because some of those companies are paying out all of their earnings, and in some cases more than all of their earnings, if they're borrowing money in dividends. Well, that dividend may not be sustainable going forward, and there may be this trade-off with growth. So we do need to consider that. And we'll talk about some of the things to look for in a company when we're trying to find a good, solid dividend payer that will grow over time. But just important to always remember those capital allocation decisions, and they do have impacts for investors. All right, so we're going back to this chart again. Once again, same theme. Income investing is more than picking shares with the highest yields. All right, from this same study, that I mentioned earlier, this Ned Davis Hartford Fund study, which there's a link to in that article on why I'm an income investor that I put in the notes. That same study looks at if dividend paying shares outperformed overall, which are the ones that actually outperformed? And how can we find those as investors so that we're not sacrificing capital growth just from investing for income? So what they did here is they divided up, and this is a even longer study, 1930 to 2022, at the S&P 500. Once again, these are US shares. They divided shares into quintiles according to yield. So what that simply means is the first quintile are shares that are the highest yielding shares. That fifth quintile is the lowest yielding shares, or most likely companies that do not pay dividends. So what they looked at is the percentage of time that those companies outperformed the S&P 500, so outperformed the index based on where they fell in those quintiles. So where are we really seeing the outperformance, the highest amount of outperformance? It's that second quintile. It's not the highest yielding shares, but those shares that are in that 60 to 80%. So in terms of the dividend yield when we rank them. And you can see there's breaking that down by different time periods. But that gets us back to the same chart we looked at before, this figure 7 that we looked at a previous slide. So what they've done is we, of course, concentrated on dividend payers, and we concentrate on dividend non-payers, looking at the returns over that 30-year period, looking at the amount of volatility, those two risk measures, beta and standard deviation. But they also divided them up into different categories. And we can see these categories. So we had dividend growers and initiators. So dividend grower, of course, is a company that has grown their dividends over that time period. Initiator is a company that did not previously pay a dividend and is now paying a dividend. We have no change in dividend policy, so they are not changing their dividend, flat dividend. We have dividend cutters and eliminators. Remember, we talked about that problem with the dividend is, of course, it can be cut or eliminated. Now, it should be fairly obvious. What are the companies we want to invest in? We want to invest in these dividend growers and initiators. So highest return of all the categories, higher than just regular dividend payers, lowest risk. So using both of those two scores, those dividend growers and initiators, that's really the sweet spot. So that's what we want. Now, those are the companies I talked about earlier that are able to, yes, Peter, that is, just saw your question. That is both capital gains and dividends. But what we're looking for here is we're looking for that sweet spot. What are those companies that are actually growing their dividends? And we have to remember that, of course, that dividend growth is also funded by the fact that they are growing earnings, right? That's the only way that somebody pays a dividend. What we want to avoid, which gives us the lowest return and the highest risk, so the highest volatility in the share price, is dividend cutters and eliminators. And that is what we call, at the end of the day, a dividend trap. So what a dividend trap is that an investor goes out, an investor just says, I'm an income investor, I am going to look for the shares that have the highest yield, and I'll just buy those. All right, so that's my strategy. Dividend investing is easy. I have a certain amount of money, I want to get the most income. But there's a couple issues with that. So the first issue is, what we talked about. Potentially, if they're paying a really high dividend, then they are paying out most of their earnings. There's little to invest in growth initiatives. And they're potentially doing that, paying out a really high dividend because they know there isn't growth. They're in an industry where there isn't a lot of growth. So they might as well give the money back to the shareholders. The other issue that we have with dividend traps is, remember our definition of dividend yield. When we look at a dividend yield, we look at the previous 12 months of dividends that have been paid, and we divide that by the share price. Now, a couple things that we should think about on both sides of that equation. One is that, of course, a dividend is not guaranteed. So the fact that they paid this dividend in the past does not necessarily mean they can or will pay that dividend in the future. The other thing to consider is that, of course, the market reacts to future expectations, and prices change based on future expectations and shares. So if the share price drops a lot, that dividend yield goes up. So why did that share price drop a lot? Well, maybe the market's acting irrationally, but maybe the market is rationally assessing the prospects for that company and saying, this company is not going to do well. That dividend is not sustainable. That will not be paid into the future. So that's what we mean by a dividend trap. And that's why sort of this simplistic notion of going out there and buying shares that have really high dividend yields is not the way to go. We need to understand the company and understand why that dividend yield is so high. And that, of course, involves the same type of analysis that we need to do on any company that we go out there and buy. And that brings us to our next slide. And when we're thinking about stable dividends, so that's sustainability that we're looking for, with growth potential, what are some things we can look at? And this is not that different than what we would look at. In fact, I would argue, I guess it's completely the same, that what we would look at in any investment that we want to go out there and buy. But if we're talking about dividends, we've got one step. First, we need to evaluate the willingness and commitment of management to the dividend. And that is because dividends are a choice. Management can choose to, as we saw on that capital allocation slide, management can, of course, choose to do all sorts of things with money. They can pay themselves and pay their employees. They can buy private jets. They can go out there and buy a new company, empire building. They can pay off debt. They can choose to do all sorts of things. So we do want to, of course, evaluate that willingness and commitment. There's sort of two ways to do this, right? Obviously, there's history. And, the history of a dividend, the very least can show you, is that management committed to paying that dividend? It may fluctuate as earnings change, of course, but are they consistently returning cash to shareholders from a dividend? We can also potentially look and see if there's a formalized dividend policy. So some companies, particularly Australian companies, and I'll talk about that in a second, but have set dividend policies. A set dividend policy can be, we will pay 80% of our earnings out as dividends. So that's something that you can look at as well. Some companies don't have them. Some companies have them. So what you tend to see in Australia, just if people are investing in Australian shares versus, let's say, US shares, but you tend to see in Australia and tend to see in a lot of global markets other than the US, is you tend to see a company with a set dividend policy like that, and you'll see more fluctuations in that dividend, right? So let's say, and I don't know what BHP's exact policy is, so don't quote me on this number, but if you're BHP and they say we're committed to paying 70 to 80% of our earnings out in dividends, well, as the earnings go up and down, you'll see that dividend go up and down. Now, hopefully over time, it's marching upwards, and these are just kind of some sort of volatility in dividends. Over time, as they grow earnings, it'll go upwards. But a company like BHP is a cyclical company. Commodity producers are generally cyclical. When expectations about the economy are sort of roaring, commodity prices tend to go up. It benefits those companies. So that's a consideration about investing in Australia. The US is generally very different. The US has lower payout ratios. Payout ratio is the percentage of earnings that are paid in dividends. So they have lower payout ratios, but there's this real stigma around cutting dividends. So US companies generally will do anything possible not to cut a dividend. So what they will do is they'll set that lower payout ratio, kind of the extra cash, the variable cash that's returned to shareholders will often go through buybacks that they can fluctuate based on their fortunes, but they tend to try to at least maintain that dividend. So it's just differences in the way that companies act in both countries. So just something to think about. All right, so that's kind of our dividend check. But then we want to look at how do we want to evaluate a company in the first place. So remember, dividends are paid out from earnings. We want those earnings to grow over time if we want dividend growth. If we want stability, we at least don't want those earnings to fall. So we need to assess the ability of a company to grow cash flows in the future. One way, of course, doing this that we talk about a lot is finding a company with a sustainable competitive advantage or moat. So that is a company that has the ability to hold competitors at bay, which is a very good thing if you're a company, which it allows you, of course, to at the very least maintain your earnings and hopefully grow them into the future because you've got that competitive advantage, a sustainable competitive advantage over the companies you're competing with every day for sales. So looking for companies with moats. The predictability of future cash flow. So especially if you're looking for stability of dividends, that predictability of the future cash flows and earnings that a company earns are really, really important. And so what that means, if that's your focus, means looking at companies with lower levels of business risk and lower uncertainty. So uncertainty rating is a rating that our analysts use at Morningstar. But even if you're not using our research, it's looking at, okay, what is the business that this company is in? And what are the different factors that will influence profitability of that company? So I mentioned BHP, for example. So BHP is very dependent on, of course, commodity prices. Now, BHP is also a giant global company that has a large range of different commodities that they mine. So they've got iron ore, they've got nickel, copper, etc. So they are not as dependent on one price. They're obviously dependent upon all these different commodity prices that they produce. We compare BHP. So even though they are very dependent, their earnings are very dependent on something mostly out of their control, those commodity prices. We compare a company like BHP to a company that just mines iron ore. So what has the biggest business risk? Well, you'd have a bigger business risk with a less diversified product range. So that's an example in a commodity producer. But then we can find even lower business risk companies. What about somebody who's not as dependent on commodity prices? What about somebody who is producing something that people are going to buy no matter what? Or they're going to go shop at this place no matter what. So let's take Kohl's or Woolies. And obviously there's been a lot in the media lately around prices and inflation and everything else. But no matter what happens with the economy, you need to buy food. So you're going to see less fluctuation in earnings for a company like Kohl's or Woolies. So those are consumer staples. So what it's thinking about is where on that spectrum does a company fall in terms of the influences that will impact their earnings. So something to think about, particularly if you're looking at stability of dividends. Finally, another really important thing with dividends or evaluating any sort of company, and this is, the previous point's very important as well. You should understand the drivers and influences of that company making money. The last one is that you have to have the ability, of course, to pay a dividend. If a company is heavily indebted and all of their cash flow is going to try to service their debt, they can't pay you dividends. So we want to look at the financial position of that company. And that's going to influence their ability to grow and maintain a dividend. So that involves evaluating capital allocation decisions. Has management, and this is another rating that we have at Morningstar, but has management gone out and done a bunch of stupid things with shareholder capital? Have they made a bunch of costly acquisitions that have not worked out? Have they gone out there and decided that every time they do well, they're going to give all their money to employees as bonuses beyond the need to retain employees? They're making a lot of dumb capital allocation decisions that can, of course, put their financial position or put them in trouble from a financial perspective. We want to look at their debt levels. Debt levels are really important as well. And we want to look at those dividend payout ratios. How much wiggle room do they have? If you're paying out 100% of your earnings dividends, then that could be an issue, right? Any fall in earnings means that you're in a little bit of trouble, right? So all of a sudden you have to start cutting that dividend if earnings fall. If you have more of a cushion, you pay out 50%, well, then you can make a decision. Well, earnings have gone down, but we still have more than enough to cover the dividends and some other stuff. Gives them more flexibility. So something that's important to look at as well. So I've seen some questions come in, so I'll pause for a couple questions. So Doug, I think I got your question. Is that, I don't know what the SD is. Sorry, I don't think I've answered. Is the SD based on the average returns of the overall index? The standard deviation. Okay, so the standard deviation, unlike beta, now I know what you're talking about. Unlike beta, where the index is 1, the standard of deviation has nothing to do with the index. The index will have a standard deviation. It's just looking at, we'll take the ASX 200, it's looking at the average return. So if we're looking at a 10-year period, and let's say the ASX has returned 10% a year. If every year during that 10-year period, if 5 of those, the index returned 11%, and 5, it returned 9%, that would be a very low standard deviation, right? The dispersion around that average is very, very tight. If instead 1 year the ASX returned 30%, then it returned negative 20%, and then 50%, negative 40, like, whatever, the average is out to 10, it would have a very high standard deviation. So in the case of standard deviation, we can calculate it on an index and then compare an individual's share or group of shares to that index. So I hope that answered your question. So the anonymous attendee said, from a practical viewpoint, how do you select growers and initiators from a list of stock? Does Morningstar try to categorize them? Yeah, so hopefully I answered that on this slide right here, is once you have the willingness and the commitment of a management to pay a dividend, then you need a company that's going to grow its earnings at the end of the day. So what you're looking for is growth and all the things that we want to do to evaluate growth. Now, the one thing that is not on this slide is, of course, valuation. Now, valuation, if you're just looking at an income perspective, maybe doesn't really matter. But remember that valuation, the higher valuation, the lower the yield is. But really what we're looking for is growth, and that will give us dividend growth. All right, got a couple more slides to go quickly. So I wrote one of the articles that I put in there. I think it's how to build an income portfolio. I created this little spreadsheet for people. So if people want it, email me. And it looks at 2 different things. It looks at the sources of income from a portfolio of income growth. So really what the spreadsheet's looking at is, let's say you have a portfolio of $50,000. This is an example. The yield on your portfolio is 4.4%. You think dividend growth is 3.5%, and this allows you to go in there, those highlighted cells you can actually manipulate. If you want to put your own portfolio, you think dividend growth will be 3.5%. You're putting new contributions into your portfolio, and what's the expected yield? So you think you're going to go out there and buy new things that yield the same things as your overall portfolio. What this does is it looks at where growth is coming from. Because a lot of people that are trying to generate passive income, potentially for a future event like retirement, where they want to start spending it, you want to calculate the growth to figure out how much you actually have in the future. So what this basically breaks down, assuming your reinvested dividends, breaks down the components of growth. So you've got a current income of 2,200, 50,000 times 4.4%. You're reinvesting that income that you're receiving, you're reinvesting $2,200 at 4.4%. Means you're growing your income by $96 a year. You are calculating 3.5% on those dividends. So that's that 2,200 growing, and you're saving $1,000. So you're adding into that portfolio. So what you can see is actually the components of that dividend growth, which I've always found is helpful. So allow me to sort of think of those different sources of growth and how I can potentially impact them. Can I find companies that are growing their dividend a higher percentage, even if I'm lowering that yield? Can I save and invest more in new investment to try to get that growth? So what does this show you? From these three sources, you're growing your income 9.9%. So what that allows you to do is think about, okay, what is my growth over time as I try to achieve my goal? The other component of the spreadsheet is this trade-off that we always talked about between growth and high yield. So many people may think that even if they avoid those dividend traps, they may think, okay, well, the best thing to do is find the highest yielding shares that are not dividend traps and aren't going to cut their dividends. Well, it depends how long you're investing, right? Because over time, even a lower dividend yield will eventually create a larger income stream if it's growing significantly faster. So all this allows you to do is, once again, manipulate a couple cells, these highlighted ones. So in this case, over 10 years, I wanted to see, okay, what's my income in 10 years? And obviously these are estimates, but you can use it to screw around a little bit. Well, okay, we've got one share that is going to grow 10% at a lower yield versus a slower growing share at a higher yield. And we can see that actual percentage growth that's going to equal the same amount of income. So we can think about, okay, if I can find shares, even if they yield lower, that grow faster, that's an opportunity. So once again, just things that I screw around with, try to remind myself that if I'm trying to grow my passive income in the future, what are the different components that will lead to that growth? All right, so I think we've got a couple more questions, which I'll dive into. Those are the slides. And I think somebody did ask for, excuse me, somebody did ask for the slides, so just email me, I'll send them to you. And all those charts that I used from that research, I said that link's available in the Why I'm an Income Investor article, but also if you email me, I can send it to you. Okay, so we seem to have some questions. Okay, special dividends. So let's talk about special dividends. Yeah, special dividends are generally outside of the policy. So what is a special dividend? The miners, a couple of years ago, a lot of the miners issued special dividends. That generally happens as the comment, or as a couple of the comments said, generally happens if there's this extraordinary year that they don't necessarily think will be maintained. So commodity prices shot up, they had this huge profit. So they still want to give earnings back to investors without raising that standard dividend too much. Now, just remember, special dividends, depending upon how it's measured, some of them can get caught up in those dividend yields, depending upon how they measure it. So yeah, just be thoughtful about special dividends, because they're special for a reason. Doesn't mean they're going to happen every year. Those are the regular dividends. So yeah, something to think about. Let's see, what else do we have? Yeah, so good comment by Nick. It would be interesting to understand the performance of those that borrow to maintain dividends and their performance. They would probably fit into dividend payers with increasing debt, with most of it going to pay dividends, would be a leading indicator of a future dividend cutter. Yeah, absolutely. So companies do occasionally, it's really not great policy over the long term, they will borrow to fund a dividend. So basically they will have a shortfall in earnings, and they want to maintain the dividend, so they'll just go out and borrow money. And that's, I don't know if it's fine, but that's something that over the short term, you can, of course, do. But over the long term, as you keep piling up more and more debt to pay money out to shareholders that you can't cover with your earnings, eventually you'll go bankrupt. So that is something that's important to look at, and look at those changing debt levels and looking at the cash flow that is generated from dividends. Let's see. Okay, Peter, sorry. We should have replays of this webinar and the other two in the next couple days. I got that cancellation notice as well, which I thought was very strange. Anyway, yeah, I don't know what happened. All right, I think we've answered everything, and it's 7 o'clock. Okay. Well, thank you guys very much for joining. So we are taking a break, I think, for the next 2 weeks, but we will send out the next series of webinars in the next couple of weeks. So hopefully you guys can join me then. And yeah, as I said, send an email with any questions, comments, anything else. And yeah, I'll try to get back to you, maybe not tonight, but in the next couple of days. Anyway, thank you guys very much for joining.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.